To talk about where we have reached after this rally and whether we can go even higher from here, Nilesh Shah of ICICI Prudential Asset Management Company is with us now. Morning, Nilesh. Thanks for joining in. What do you think? Do you think we have moved after the rally to fair value, or is there a lot of headroom left here?
I think we have moved near the fair value in the short term. There has been bit of short covering, bit of FII buying, bit of insurance companies fourth quarter buying, bit of global recovery, bit of Indian recovery, and that's why all this forces put together has pushed the market up here. And now we'll run into the result season. The political risk continues to be there, and hence probably till such time the election results are out and the reform process for the next government is set up, we will probably see a market which is kind of tapering off at current level rather than move in a particular direction.
What about the technicals of the market, Nilesh? Do you still see a lot of cash which may have missed out on this rally and therefore may want to jump in, and could that keep the market supported, or do you think those adjustments have been made?
Definitely there has been fair amount of cash waiting to be invested in the market, both at the FII level as well as the local institutional and local retail level. However, my feeling is that this cash, which has remained uninvested for a reasonably longer period of time, would love to remain in cash rather than participate in a rally at a higher level. Mind you, the valuation wise, if we are looking at between 800 to 850 rupees earning per share for the Sensex, then Sensex is trading at about 12 to 12.5 times forward P, which is reasonable.
Nilesh, morning. I remember we were talking a couple of weeks back about the kind of allocation one should do between a fixed income and equity. Are you getting the sense, though, that tactically it's probably a good time to start increasing exposure to equity?
I think for the retail investors at this level, probably they should look at their asset allocation, and if they are hugely underweight equity, then yes, these are the levels to put equity. But keeping fully well in the mind that there will be an election result, and if election results are not in anticipation with the market outlook, then there could be a fall in the market like in May 2004. It will be temporary in nature, but there could be similar kind of fall in May 2004 if the election outcome is not in line with the market anticipation.
From what you're seeing in terms of what's happening with the yields, though, Nilesh, how are you approaching the banking space right now?
The banking space right now looks a little bit vulnerable to rising concerns on the non-performing assets. They will also not be supported by the treasury income this quarter, as the yields have jumped up significantly from 5 quarter last December to probably about 7% this March. So banking stocks will have results which will be little bit weaker, either because they are not supported by treasury profit or because they will have to provide for the NPAs.
Do you see the market having steam enough to rally into the elections, Nilesh, and then wait for the outcome? I mean, we still got at least a month or maybe more till the election results come out. Do you see this rally extending till then, and then depending on the result making its next move up or down?
My feeling is that as of today, most of the institutional investors are assuming that there will be a reasonable government, reform-oriented government post-election. However, as we go into the election and some of the opinion polls suggest something to contrary, then those kind of things may force investors to book profit, because from the bottom we are up about 25-30%. And hence my feeling is that people will try to anticipate future and discount it before it actually happens. So there could be some rally from the current level, but definitely the election risk will have to be priced in before the election and not only after the election.
As you said, I mean, we have come a long way from the recent lows, 25-30% plus. In case of a poor election result, do do you think the market could still go back and retest those kind of lows that we saw in the start of March? Or do you think the chances of creating a much higher floor, even after an election disappointment, is more probable?
It will actually vary with what kind of disappointment we have. If it's, at the end of the day, there is a reasonable coalition which has been created and they commit to the reform process, then certainly we are not going to see the previous lows. But suppose if we are unable to form the government and the whole process kind of becomes quite open and not time bound, then certainly we can test the lows. So it will be very difficult to predict what will be the impact of the election result onto the market.
You keep an eye as well on institutional flows across the Asian region, Nilesh. When you say that cash is waiting to be invested, is it waiting for an event like the elections, or are most fund managers you speak with just waiting for another dip in this market?
My feeling is that after talking to various people, somewhere there is an impression that Indian markets are trailing probably 2-3 months behind Chinese market. So somewhere how the Chinese market behave probably influence allocation to Indian market also. Second, the emerging market flows have turned positive. Emerging market funds, global funds, both have started receiving cash from investors, and they are all looking to reinvest in India. The third factor, which is somewhere there at the back of almost all institutional fund managers' mind, is that China and India, in that order, will be the two countries to recover from the global downturn. So they all want to invest in India at appropriate level or appropriate time, and depending upon their view and outlook, they keep on sending some allocation to India. If we see the last 30 days flow, last half of March and first half of current month, it's not that one person has driven the flows. It has come across many people, and all have come in smaller quantums, and that's why probably we missed out the whole big picture. So all this anecdotal evidence do suggest that there is cash waiting to be invested, provided we can provide them the conducive environment.
How likely does it seem, though, Nilesh, that it's actually the first half of this calendar year that throws up the best part of the price performance we see on the market?
Removing the election uncertainty out, I think yes, the first half will show reasonably good opportunity, because the way the fiscal stimulus package has come out, the way the monetary policy has been eased, it all gives hope that the second half of FY10 will be much better in terms of economic performance. And obviously we are assuming a normal monsoon here. Now market will be probably 3 to 6 months ahead of the economic recovery. So they will try to price in second half recovery in the first half, and hence the first half's price performance, removing the election uncertainty out, will be far better.
Last few months, mutual funds, equity funds, Nilesh, have been holding on to a large amount of cash. I don't know about your fund specifically, but generally cash levels have been 20% plus. Has that been deployed considerably in the rally of the last 1 month, or do cash levels for domestic mutual funds still remain very high?
At ICICI Prudential Mutual Fund, we have never taken cash calls, so our cash balance have normally averaged between 5 to 15% according to the mandate given. When the markets were falling down, we paid the price because we were not in cash. However, we have benefited when the markets have went up. My feeling is that most of the mutual funds would have reduced their cash balances based on whatever we hear in the market, and they would have participated into this rally by reducing their cash balance.
So what kind of a range do you see now for the market till we have a conclusive election result for the index, Sensex or Nifty, broadly speaking?
Somewhere around 10 times forward earning to 12.5 times forward earning looks like a reasonable range, which probably will translate between 8,000 to 8,500 on lower side, and about 10,500 to 11,000 on the higher side.
Thanks, Nilesh. We'll leave it there. Good talking to you as always. That's Nilesh Shah of ICICI Prudential Asset Management Company saying, done probably for the moment in terms of fair value, and now we wait for the election results for the market to make its next big directional move. He doesn't see a whole lot of upside from here till the elections are out of the way. That's his view. 8.5 to 11,000 is broadly the range that he is talking about.